All right, gang, welcome to Chapter 3. We're going to be learning how to adjust accounts and preparing financial statements. Let's go ahead and dive right into the subject matter. By the way, if you're having any questions or difficulties before we get started, please feel free to shoot me a message, send me a text message, and we can plan some time for a telephone call. It'll probably have to be on the weekends, but please feel free if you are struggling with any of these concepts. Let's go ahead and dive right into Chapter 3. Remember, we learned in Chapter 1 that one of the main assumptions that we'll be dealing with, of course, is the time period assumption. And all that states is that we presume that the life of a company can be divided into periods such as months, years, weeks, whatever have you. Now, most of the time we'll be dealing in months and years. Nothing too complex there. I mean, it's usually quarters, months, and years that we will break up our periods into, and more specifically, that our financial statements will cover. And really important thing to think about as we start talking about what accrual basis of accounting is versus cash basis. So accrual basis is what we're going to learn all semester. Cash basis is something you do not need to worry about. I'm just going to point it out momentarily. Under the accrual basis of accounting, revenues are recognized when they are earned, and expenses are recognized when they are incurred, which we learned is when we use up the value of an asset. Not just spend cash, because it depends what we're getting in exchange for that cash, or when we spend a resource, it depends what we're getting in exchange. But when we use up the value of any asset, that's when expenses are incurred and we need to be recognized. Under the cash basis of accounting, that's basically revenues are recognized when cash is received and expenses are recorded when cash is paid. That's the sort of accounting that's used for income tax purposes, but not for financial accounting. That is not recognized as generally accepted accounting principles, which is what we spoke about in Chapter 1 and what the chapter does a really good job of explaining. Those are the rules that we follow for proper financial accounting. And so under the generally accepted accounting principles, we follow these two main principles. The revenue recognition principle, again, recognize revenue when it's earned, only when it's earned, and every time that it's earned. Collection of cash is irrelevant for when revenue is recognized. We've earned revenue once we have done our earning process. So if it's a service we're providing, once we have provided that service completely, we must record revenue into our accounting books. By the way, in chapters 1 through 4, we're only going to be dealing with service companies. Not until after the midterm exam that we'll start dealing with merchandising companies, which buy and sell products, not just services. So for now, all we got to worry about is services, and we recognize revenue when we have provided our service. We've done all the work we need to do. And remember, the expense recognition principle is also called the matching principle, because we will record our expenses in the same period. We're going to match our expenses to the revenues that those specific expenses helped us generate. So for example, when we spend money on our rent for, let's say, January, in theory, we paid that rent for January and it helped us earn revenue in January as well, right? In theory, we couldn't run our business if we didn't rent out the offices that we did. So we would want to match those revenues those expenses, that we paid in January with the revenues that we earned in January. So we would record those specifically in January. Another way to think about it is expenses must be recognized when we use up an asset. And we spoke about that, but we're going to go through a couple examples just to make sure everyone's up to speed on that as well in Chapter 3. And these are key concepts. You've heard me say them and repeat them over and over. The reason is because if you do not get a firm handle on these two concepts that we just discussed, revenue recognition and expense recognition, you will not succeed at this class, or it'll be very difficult to succeed. So please spend the time, understand those two principles well, and everything should be fine. Accounting shouldn't be all that difficult. Again, revenue recognition principle, only when we deliver our products or perform our service to our customer do we record revenue as earned. by that same token, by the expense recognition principle or matching principle, once we have recognized revenue, we want to take a look and see what expenses we incurred in order to generate that revenue, and we must record those expenses. That's where the matching part of the expense recognition principle comes. By the way, those terms are interchangeable: expense recognition principle and matching principle. Okay. And remember, just as we don't simply record revenue when money is received or when cash is received, by that same token, we don't just record an expense when money is spent. There's a key question to ask when we spend money. Are we just using up the value of that money, meaning is it already used up and we aren't getting anything that's going to give us any future benefit because we've already used it up? If so, it's an expense. If we're spending money and we are getting something that is going to provide us some future benefit, it's not an expense that we're getting for that cash. We're getting some sort of another asset, and it's real important that we record an asset. So let's go ahead and jump into a couple examples. I, of course, am a criminal defense lawyer, so let's go ahead and use law firms. I think it's a real good example to use as a service company, right? So lawyers in generally aren't selling products, they're selling themselves, their time and their energy and their research and their counsel. These are all services. So not selling a product, but selling a service. And let's assume that our company, for these examples, and we're going to go through several, is a law firm, and we're preparing our June financial statements. Okay, we were going to put out financial statements so that all the world can see, and we have to make sure they are accurate, of course, and conform to the generally accepted accounting principles. So we're going to run through a couple examples here, and I'll posit them and try and answer them yourselves, although I will tell you what the correct answer is. But I want you to think about it. So in June, we worked 100 hours on a big case of ours, and we charged $500 an hour. That's going to be $50,000 total that we've worked. But we haven't sent a bill to our client yet, and they haven't paid us for that service, but we know they're going to in the future, right? So have we earned revenue, or do we have a liability on our hands? Do we owe something now? Think it over. And yeah, absolutely right. I know you guys were thinking the right answers here. We earned revenue. We've done our work, right? We worked 100 hours in this example, and that's the key part. We've done our work, so we have done our earning process, so we would record revenue in this instance of $50,000. And if you take a look at that magic slide, handout number 2 from chapter 2, right? I want you always to have that slide handy. Trust me, it'll come in handy. To record revenue, we would, of course, credit the revenue account for $50,000. And, of course, think about what the debit would be here. We haven't received cash. If so, we'd be debiting cash. Instead, our client owes us $50,000. So we would have an account receivable from that specific client, right? Mr. Big, if it's big case. An account receivable from Big for $50,000 would be the debit. And we would record revenue, of course, crediting revenue for $50,000 as our credit. And those would be our debits and credits, and they would be equal. Let's move into example number 2. Let's say in June we received $25,000 from a small client of ours, Mr. Small, right? Whose case we will work on in September. He's just paying us his retainer up front, giving us $25,000 cash. So we got the cash in June. Do we record revenue in June or a liability? And yeah, we have not earned this money yet, right? We're going to earn it in a few months from now, in September. So all we did was receive cash, right? Our company's cash has gone up by $25,000. We would debit cash, but we don't credit revenue because we haven't earned it yet. Instead, we would credit a liability account, which we are going to learn in this chapter called unearned revenue. That is a liability account, okay? It's also getting a credit, just as you'll see on that magic slide from class number 2, to show an increase of revenue or to show an increase of a liability. Both of those are normal credit balance accounts. So to increase them, we would, of course, credit those accounts. And that's what we'd be doing in this example. Debiting cash and crediting unearned revenue. Example number 3. Let's say in June, our law firm now pays $1,000 cash to researchers for the work they did in June on the big case for us. Do we record an expense or have we gotten an asset, right? And these are the two questions I want you to ask. Has it helped us earn revenue in the past or presently? Or are we getting something that's going to benefit us in the future, meaning we're going to have a future benefit from this? If it's something we've used up and it helped us earn revenue in the past or in the current period in June, it would be an expense. If it's something that we own is going to give us a future benefit, then of course it's an asset. And in this example, we already used up the $1,000 cash. We used up all the value. The researchers did their work in June and in theory helped us earn whatever revenue we were going to earn in June already. We've used up that $1,000 completely. It's an expense for us. And of course here we'd be crediting cash for $1,000 and debiting a specific expense account. We'd probably call this research expense or something to that effect. Don't worry necessarily about the names of the expense accounts, just understand that it is an expense. Okay, so let's go on to example number 4. In July, assume that our firm paid $10,000 for the June rent of our law offices. Do we record an expense or an asset? Remember, of course, we're going to be showing the decrease in cash, which would be a credit to cash for $10,000. And yes, of course, we would have used up all the value of this back in June, right? So we would take an expense for $10,000, right? When we pay our rent for last month, we're obviously not getting something that's going to benefit us in the future. We've already used up that $10,000 worth of rent the month prior. But stick with that example for a second as we move into 5. Keep that in mind. Say in July now we're paying $10,000 for August rent of our law office, right? So we're paying for a future rent period. We haven't used up that rent, so here for this transaction we would of course credit the cash account for $10,000 to show that our company's cash has gone down by $10,000. But rather than debiting a rent expense, since we haven't used up that rent yet, we would actually be debiting something called prepaid rent or some prepaid expense account, which is actually an asset. We now own something, right? We own the legal right to inhabit and to occupy our law offices for the month of August. If someone tries to take that away from us, we can of course sue. So we must show that we legally own something. Now at the end of August, of course, we would want to change that from an asset, right? We would instead be crediting that prepaid rent account and debiting the actual rent expense account. We would be changing it from an asset to show that we have used it up, which is an expense. These are key concepts. Again, I want you to understand what the revenue recognition principle is and the expense recognition principle. If you're having difficulty with any of these, spend some time on it. If you're having a lot of difficulty after spending some time on it, send me a message and we'll schedule some time just so we can go through it. Like I said, these are key concepts. You're going to need them to succeed in both Accounting 201 and Accounting 202. So please spend some time on both the expense recognition principle and the revenue recognition principle, which really go hand in hand. And we'll stop there for part 1 of chapter 3.